Again, thank you to everybody who has joined us today for this session of the AgrAbility webinar series. My name is Paul Jones. I'm the manager of the National AgrAbility Project, which is headquartered here at Purdue University. Our subject today is on alternative financing for assistive technology. And our presenters, Susan Takaw and Tracy Beck, are both from the Pennsylvania Assistive Technology Foundation. They're going to be joined by two of our AgrAbility staff members for some comments toward the end, Karen Funkenbush from Missouri AgrAbility and Abby Spackman from AgrAbility for Pennsylvanians. Some of you may not be familiar with the AgrAbility program. We are sponsored by the U.S. Department of Agriculture, and our focus is on assisting people in agriculture that have some type of disabling condition. Every one of the AgrAbility projects, and there are currently 20 state projects, every one of them is a partnership between a land-grant university and at least one nonprofit disability services organization. There is also one national AgrAbility project that assists the other state projects. And again, that's led by the Purdue Breaking New Ground Resource Center, and the partners on that grant include Goodwill of the Finger Lakes, APRIL, which is the Association of Programs for Rural Independent Living, Colorado State University, and Washington State University. If you would like more information about AgrAbility, feel free to browse the agrability.org website. And again, we do have archived webinars on that site, over 80 right now, so feel free to check those out also. At this point, I'm going to turn things over to Susan Takaw and Tracy from the Pennsylvania Assistive Technology Foundation. They will give the main body of the presentation, and then I'll return after the presentation for the poll questions.
Thank you, Paul. And please let me know if you can't hear us.
We can hear you fine, yeah.
Great. You'll see on this first slide 4 pictures of some assistive technology with farmers from Pennsylvania that our AgrAbility project has helped get the financing for through us and through some of the alternative financing, including from our state's vocational rehabilitation. But when pulling together this webinar, I included these pictures because it shows the wide variety of assistive technology that needs financing. And from my experience working with some of the AgrAbility projects, there often has to be multiple funding resources. Some states, their relationship with vocational rehabilitation is very strong, and that voc rehab agency has more money than in other states where it's far more limited. To kind of set the ground, kind of set the stage, I wanted to let everybody know about one of the most robust funding resource, and that's the alternative financing programs. So I'm not going to read from these slides, but as Paul told you, this PowerPoint will be available to all of you. The alternative financing programs are part of the state's Assistive Technology Act programs. What is now called the Assistive Technology Act was originally called Technology-Related Assistance for Individuals with Disabilities Act of '88. It's been reauthorized like 4 times. It's now called the AT Act. And as part of this federal legislation, there is a program in most states called the Alternative Financing Program. So right now, there are about 40 alternative financing programs plus 2 state AT program financing that are all committed to helping people with disabilities in their states. And one program, Washington and Oregon, it's one program that covers 2 states. New York also has a program, New York and New Jersey. But all of these programs, their mission is to help people with disabilities acquire the assistive technology that they want. It's interesting that AgrAbility first got their funding in the beginning stages of the Tech Act. So for some of you, you may be very familiar with your Assistive Technology Act project. And as Karen from Missouri aptly pointed out, we get very caught up in our lingo, and I want to make sure that everyone is under the same language of the Tech Act project is the same as the Assistive Technology Act project. Within those Assistive Technology Act projects, you have alternative financing programs, also known for some projects Title III of all things. But basically, what it's all about is that a major funder for many farmers can be the alternative financing programs. As of December of this December, as I pointed out, there are 40 alternative financing programs. There are 2 state AT financing programs, and those states I don't believe have AgrAbility projects. Those 2 states are Hawaii and Connecticut. So how do you know if your state has an alternative financing program? We have a link on our website, PATF, Pennsylvania Assistive Technology Foundation website. And here is a hyperlink. So if you want to copy this or get a copy of the PowerPoint, you will be able to go and link on. So, for example, there's a program in Missouri, in Michigan, Oklahoma, Kansas, Kentucky, for example. So, and there should be a great partnership and collaboration. So that is kind of your first step, I think, if you're going to look at alternative financing. So the big question is, what do alternative financing programs do, AFPs? So what do they do? We have a similar mission that with AgrAbility, and that our mission is helping individuals with disabilities acquire the assistive technology that they want. We help people of all ages, all income levels, all disabilities and health conditions. And the reason that all disabilities and health conditions is relevant is that the AFPs do not use the medical model, meaning in order to participate in our programs, you do not need a doctor's prescription, you don't need a diagnosis. What you are doing is describing why a particular device is assistive technology for you. An example would be, like in the first slide, the sons, the 2 little people, their assistive technology is the utility vehicle. So when we were working with AgrAbility about this story, it didn't matter very much at all that they were little people. What mattered was, why is this assistive technology? And it's assistive technology because it helps them get around the farm, and that they are farmers on their family farm. So the diagnosis doesn't matter, and I think that's relevant for farmers because farmers are not often going around saying, I have a disability. Rather, they have arthritis, they have a sore back, they have joint problems, they have COPD, and that is what determines what is assistive technology. And all of the alternative financing programs, they're concerned about funding the assistive technology. Where is this important? It's when somebody needs something that's not assistive technology. And Tracy will talk about this, but for example, we're all about trying to help farmers get the equipment they need, but if they need a new roof, that's not assistive technology. Most of the alternative financing programs are very concerned that these are consumer-directed, consumer choice programs. in order to have true consumer direction, that means you have an informed consumer. So that means you know what your choices are, what your options are around funding. So the alternative financing programs, their core service is all around funding. So most of the alternative financing programs have put together information, and in some states this is put together actually by the state assistive technology program. They put together resources around funding. So the very first state to have done this was Kentucky, and I've included in here a copy of their latest edition of their book called The Buck Stops Here, A Guide to Assistive Technology Funding in Kentucky. We took that book, as have many other books, and made it our own, called Funding Your Assistive Technology, A Guide to Funding Resources in Pennsylvania. So the reason that we think that this book is helpful, and Abby can talk about it later, is because often it's not just the farmer that we're helping on a farm. It could be farm family members, relatives, people that they know, and so there will be multiple funding resources. It's not just like in Pennsylvania, where our VR, our vocational rehabilitation, is very focused on production agriculture. They're not, and we actually have a waiting list right now. They're not going to fund things, pieces of equipment that's not directly related to the production agriculture. So being able to look holistically, which is certainly what AgrAbility projects are designed to do, looking at multiple funding. So our book, Kentucky's book, I know that Oklahoma and Kansas also look at funding resources. So feel free to download a copy and see if this is something that could be useful for you guys. We also work with the extension offices, and Linda Fetzer, who is somebody we work closely with at Penn State, she had us, along with several others of you, Karen Kirk from Virginia, help put together a funding resource guide, a chart, to help get you started. And it was reposted, I believe, in May of 2019, and this is the URL for that. Again, if you write it or if you get a copy from the PowerPoint, you'll be able to click on it. And it starts off again, you know, always look at your VR agency, but look at your Assistive Technology Act project, your alternative financing program, your Veterans Administration, things of that sort. We know in Pennsylvania, for example, that the VA will pay for three mobility devices, and they will count a tractor as a mobility device. So we've been able to help some of our farmers get a new tractor through the VA, just knowing about that little benefit there. Okay, and here you have Tracy, who's going to talk about the different types of AT financing.
So there are a lot of alternative financing programs, as Susan mentioned, 42. And every AFP will, they'll do something a little bit different. So not all the alternative financing programs extend loans in the same way. There are several loan models that have been incorporated over the years. And I just wanted to, I just wanted to go through some of these and just explain a little bit about each of these bullets. I'm sure that many of you are familiar with these terms, but I will just go through them so that you are more familiar. And, of course, we're happy to take questions at the end. Direct lending. that's a term typically used by not a bank or credit union, but it's usually a loan that is directly lended out by an institution, an organization, or even an individual. So direct lending doesn't necessarily mean a microloan or a small loan. It means that your organization is able to quickly get a loan out the door. And it's based on someone's credit and debt to income. And it really is typically a faster turnaround time than going through a bank or credit union. We have a direct loan program here. We call it our mini loan program in Pennsylvania. And that is for items from $100 to $2,000 at 0%. Other states who have direct lending programs are Washington State, Massachusetts, Oklahoma, and Nebraska. So you might want to check out their websites. Credit building loans. These are typically microloans. They're smaller loans, and they're issued by, again, organizations, typically not banks or credit unions. And they're there to report credit, positive credit, when someone pays back the loan. Or if you don't pay back the loan, that's not a good thing, then your credit is affected negatively. But in our situation here in Pennsylvania, our microloans are our mini loans, and 90% of the individuals who take advantage of that microloan program or credit builder loan are very, very low income. So we're talking people who are on supplemental security income, Social Security disability, very limited. In a lot of cases, people are not working. We have seniors who take advantage of that program. Our number one loan here in Pennsylvania, and I'm sure it's in other states, are hearing aids. And I think at some point I tease my colleagues that, you know, at some point we're all going to need hearing aids. And Utah as well has a, Susan is just reminding me that Utah's number one loan is also hearing aids. We have a low interest and no interest loan. Here in Pennsylvania, our low interest loan is for anything over $2,000 at 3.75%. Our mini loan program is 0% up to $2,000. So, you know, why are alternative financing programs different than a bank or credit union? It's because we can set these low interest rates or no interest rates so that people can get the assistive technology that they need. We review credit reports all of the time. We look at debt to income, and we look at the individual situation. So, you know, not everybody who has a disability has a impeccable credit report. In fact, most people have dings on their credit report. It could be due to medical collections or student loan debt. We do look at those, and we weigh each loan request that we get. So, you know, in essence, alternative financing programs can be more creative than a bank or credit union, more forgiving when there is negative credit, and more forgiving if there is a higher debt to income. We require that someone has the ability to pay back the loan, and if they can prove that they can do that, then we are very willing to extend a loan to someone. Moving on down the list, a loan guarantee. That is a loan where one party assumes the debt obligation of a borrower if the borrower defaults. So, for example, here in Pennsylvania, we do guarantee loans, and those are the larger loans, the low-interest loans above $2,000. And we guarantee those loans so that our partner banks feel comfortable extending money to a borrower that they wouldn't necessarily extend a loan to themselves. So in essence, if that borrower defaults, our organization is on the line. The bank will come to us and say, look, this person defaulted, you owe us X amount. And we understand that. That is the agreement, so we are very willing to give the bank what is left on that loan if someone defaults. I can say that our default rate, we just calculated our loans today, and we have done about $40 million in loans here in Pennsylvania, and our default rate is less than 3%. Which is pretty incredible, and I really think, and this is not scientific, but I really think because we have a very good relationship with all of our borrowers, that they are comfortable, even if they're falling behind on a loan, to give us a call. So again, that is not something that you find at a credit union or a bank, typically, but you will with an alternative financing program. An interest loan buy-down simply means that our organization or any alternative financing organization is working with a banking institution to buy down the interest rate so it is the most affordable rate for the borrower. So here in Pennsylvania, we have a contract with 3 banks. We negotiate that contract every year, and we are buying down the interest rate, so it's set, and our interest rate, as I mentioned, is 3.75. And you really can't find a personal loan that I know of for that type of rate. And the other alternative financing programs, not all of them, but some of them also have a contract with a bank, so they are able to negotiate an interest rate that's really affordable. An unsecured loan is simply a loan that is based on a borrower's creditworthiness rather than collateral. So when you get into collateral, you're talking about a secured loan. So collateral could be an adapted vehicle. It could be a home equity loan. So the collateral is your home. So those are the types of loans that the alternative financing programs around the country use, and not all of them use all of these, but all of these models are used in one form or another. And that's okay.
So as Tracy was talking about what makes alternative financing programs alternative, she included many of the mechanisms of how our programs operate to get capital out to farmers and to other people within our states. So because our programs are receiving federal monies, some from the Assistive Technology Act, some from the Alternative Financing Program, some from the U.S. Treasury, as well as from foundation supports, we don't necessarily have to behave like a typical bank or credit union, which means our application can be simpler. So there are certain federal requirements that you have to have on an application, a lending application, but when we look and make our applications, they're not 16 pages. They're simpler, and that makes it an easier process in which to apply. All of our programs, again, look at FICO scores and debt to income. We happen to know that for farmers, often that debt to income is sky high. But we also know that farmers want to continue farming and that they are less likely to default on the equipment that makes it possible for them to farm than it is if you are living in the city and you're trying to take out a loan for a computer. The second on the top bar, the second one in the middle is our programs will blend or braid funding streams. So very, very often we are combining funding both from our programs but also from VR agencies, from foundations, from other USDA monies, like some of their housing grants, for example, from the VA. And that is something that our programs are very used to doing. We know that, and we know how to work with our partner banks. If you take out a typical consumer loan, for example, most banks will want to be in first position or maybe take second position. They will never take third position. So we know how to blend the money so that we can maximize the capital that somebody needs. As Tracy said, we have low fees, if any fees. So several of our programs have this micro loan, credit building loan, which offers no fees and 0% interest. Other programs, and then we get up to our larger loan, which may have an interest rate somewhere between 3.75. Some programs go maybe 8%, but very few programs also charge any fees. Going down on that bottom part of this slide, on the far left-hand side, all of our programs have a continued relationship throughout the process with the borrower so we can assist if there are problems. So, for example, almost all of our programs make rescue payments. What does that mean? It means that that if there is a month or two where it's very difficult, if impossible, to make a payment, we can step in and make that rescue payment so that a farmer's not in default. One time, a farmer asked us if we could hold off for a month. They would sell a cow and get back to us. We said, no. Look at your budget overall. We can make up to 3 months rescue payments. Don't sell your cow for this loan. See if, in fact, if we make these rescue payments, if given the cycle of selling produce, that would help you with your loan payments. Most of the alternative financing programs, though, they do have a, just like a more typical lender, a monthly repayment as opposed to once a year or once every 6 months. That's just for your information. We do not develop deeper relationships. That's really code for marketing other credit products. So we're not trying to sell you credit cards. We're not trying to sell you other loans at the same time of this product. What we're trying to do is literally get you the capital that you need when you need it, and we're not trying to get you overly extended. So unlike some of what you'll hear in the press with some of the banks where the people you're dealing with, the underwriters, are also under an obligation to sell you a credit card or a deeper line of credit, that's not what we are about. And lastly, most of our programs provide financial education and coaching. So yes, it's financial education, but part of it is also information about other funding resources. So how might you pull down other unearned resources for the farmer or the farm family member? And again, if you go on our website, patf.us, you will see a copy of our financial education book. You can download it for free. Oklahoma also has some materials, for example, that are very useful and I think help not just the farmer, but the farm family member. So the importance of partnerships. And once again, there are, we, the alternative financing programs, we believe that the way to best meet our missions is to form partnerships. We cannot do it alone. So there are the alternative financing programs. There are also the state assistive technology projects. And as I said, there are 2 of them that also have loan funds. There are other projects, state AT programs that do not have loan funds, but they do have information about other funding resources. Kentucky is one example where they do both. There are the funding resources within your states, like vocational rehabilitations, the Veterans Administration, foundations. To give you an example of what I mean about foundations, you've got the MS Society. In our state, we have a foundation called Achieve a Family Trust that will help people throughout the state. It's not disability specific. They're there to help fund assistive technology, and if they can provide $10,000 towards something, that qualifies within their guidelines. There are the extension offices, the state agriculture departments, farm bureaus, equipment vendors. All of these organizations, state agencies, they know about some funding resources. They may provide them themselves, like some of our equipment vendors. They actually have some financing. It may not be as great a terms as the alternative financing programs, so people should be comparing. And then lastly, before I turn this over to Karen and Abby, there are community development financial institutions, CDFIs. So CDFIs are funded by the U.S. Treasury, and I have put a link on this slide that, again, will be a link if you download the PowerPoint. And you can go to your state and see where the CDFIs in your state are. There are 3 kinds of CDFIs primarily. One, they do facility lending, so that wouldn't be relevant here, but they also do small business lending, and many of our farmers are small business owners. They also do consumer lending, which is what we do, and we're also a CDFI. As a CDFI, there's capital available to extend at no interest or low interest for assistive technology, for equipment, for employment opportunities. So particularly in those states where there is not an alternative financing program or it is not robust. So California is one of those states where there is an alternative financing program, but it is not robust. There are many CDFIs, and they will do loans for equipment. The same out of Illinois. IFF is a CDFI, and they do equipment loans. So I think instead of feeling as though there are fewer avenues, if you don't have an alternative financing program in your state, I would look and see if you're, who the CDFIs are in your state and if they will do either consumer lending or small business lending. And there is a huge new push from Treasury right now to have CDFIs do increased lending to individuals who have disabilities. So the time is now. Okay, so Karen and Abby.
All right, this is Abby Spagman with AgrAbility in Pennsylvania. Just a short background so you know the perspective I'm coming from. I work directly with AgrAbility clients in Pennsylvania, and I also work closely with PHCF, which is our AFP. I want to start off by talking a little bit about the partnership that we have with PHCF and how we utilize their resources for our clients. So we always, and we as an AgrAbility, always provides AFP information in our new client packs that all of our new clients receive when they begin working with AgrAbility. We also include other information in that packet, such as VR and FSA. So again, all of our clients are receiving that information. And early on in our conversation with our clients, we are talking about financial assistance. And as we begin to determine what their financial assistance needs are, we then can make a specific referral. So examples of when we would refer to our AFP would include if someone is not eligible for VR services. An example would be somebody who is a hobby farmer, or we had one gentleman who farmed his entire life. His retirement plan included transitioning farm ownership to his son, but he continued to work on the farm pretty much the same as before. But because he was not the farm owner and because he was not receiving a formal paycheck, he was not eligible for VR. So we referred that individual to PHCF. If someone is eligible for VR, but they need assistive technology that VR is not able to purchase. For example, in Pennsylvania, our VR is not able to purchase skid steers or tractors, but we know that skid steers can often be AT. So in that situation, we would refer the individual to PHCF for a low-interest loan towards a skid steer. Also, if a farmer needs the assistive technology quickly, that would be another time that we would refer them, because we know that they can apply for a loan and the turnaround is fairly quick compared with some other funding options. Susan talked about braided funding, and that's something that we also focus on, whether it's with VR or other funding sources. So one example that the individual didn't actually follow through on the loan, but I thought this was a unique example to share with you when it comes to braided funding. We were working with an Amish family, and the son needed a custom wheelchair. So AgrAbility worked with the doctor and the medical equipment provider to determine what wheelchair he needed. We were actually able to get some discounts and keep the cost fairly low through working with them. And the chair ended up being around $3,500. So one of the options that we suggested to the family was there was some community fundraising going on, and if the community and family members could raise $1,500, they could then take out a loan with PHCF for $2,000, which would be their no-interest loan. So an example of how braided funding could work. Also, if someone has not been able to secure a loan through a bank or a credit union, Tracy and Susan both mentioned the ability to guarantee a loan, and I'll give an example of how we were able to do that in a minute. Also, if someone, whether the farmer or the family member or a caregiver, might be eligible for a waiver or for other funding that AgrAbility knows of, but we are not extremely familiar with, this is the strength of partnerships. Our staff doesn't have to know everything about waivers because we know we can refer the individual to our AFP for that additional information. We also would refer individuals for financial education, and we've had farmers who say, I don't want a handout. They're not interested in VR. They're not interested in something that would be a grant or perceived as a handout, but they would be willing to take out a loan, and so we would refer them to our AFP. One example of a farmer that we worked with and referred to our AFP was a gentleman by the name of Todd who had degenerative disc disease and spinal stenosis. His doctor actually suggested to him that he consider an occupation that he could do from home and at his own pace. And so he began to pursue a dairy goat business. He needed some AT to make this happen, and as Susan mentioned earlier, AT can mean a lot of different things, but for this particular individual, that included a pasteurizer, a bottle capper, and an ice cream batch freezer. Not things that you would typically think of as AT, but in that scenario, they certainly were. So he needed about $25,000 to obtain those items. AgrAbility referred him to PHCF. At the time, VR did not have the funding to assist with this request, and the farmer was not able to obtain a loan from a traditional bank or credit union because his credit scores were low and his debt to income was high. So he was, again, referred to PHCF for the loan, and the loan was guaranteed by the board of directors. So that is an example of how we were able to make this work and of when and how we would refer someone to PHCF. But in general, I just want to emphasize that working with our AFP has opened up not only financial options through the loan programs, but we're also able to do a lot of problem solving together and a lot of brainstorming. We have a good relationship and partnership where we can call each other when we have questions about a scenario and work through some of that brainstorming. So I highly, highly encourage you to get to know your AFP and build that partnership there. I am going to pass things off to Karen for her to share her perspective.
Thank you, Abby. I'm going to take a different spin here. Because I want to play off of what Abby just said as well as Susan. And I'm not going to echo some of the things that Abby just said because Missouri has the same relationship with our AT program and AFP program, so we do things quite similar. But there are some key factors that I do want to point out. Number one, as Susan said earlier, can't do it alone. And we can't. And partnership is important, and it is, as Abby just said. In Missouri, we do a holistic approach of looking for alternative funding for adapted and assisted devices. So I rely heavily on the 20-plus years, I kind of sound like a dinosaur here, years of the relationship building, but actually establishing, building, and maintaining. And folks, it's time consuming. But the more time that we have invested in developing and maintaining those relationships, it's been critical to the success of our program of being able to provide funding for our farmers and ranchers and their farm families. So for example, in Missouri, because of our relationship with our AT program and our AF programs, I do have the influence, as well as my other staff, to pick up the phone, like Abby just said, and then call on behalf of our farm families or farmer and rancher to help them look at different funding options. Because we do, they have that holistic approach. And in Missouri, when we talk about a holistic approach, we get to be pretty creative because when we're looking at funding, we're going to look at the home, we're going to look at equipment, we're going to look at the farming environment, And then we're also going to look at leisure activities. So we're all over the board with creative funding and then providing people with different alternatives as to where they might go to get that funding for that adapted assisted technologies, smart technologies, and some of the other things that are needed on the farm. And so again, it is critical if you don't have a relationship with your AT program or your alternative financing program, now's the time to establish that relationship and then spend the time and effort to maintain it and keep it going. Another thing that I want to stress is that in Missouri, the continued relationships with a vocational rehab services for the blind, USDA Farm Service Agency, NRCS, doctor's prescriptions, your centers for independent living. In Missouri, those are all our collaborative and cooperative partners. So when you have those relationships as an AgrAbility project, my take-home message and advice is it's a two-way streak. It's a two-way conversation because the ultimate goal here is to provide that opportunity to our farmers to continue to farm. And if we don't help them to continue to farm, they're not going to do it in a way that we would want them to do it. And they may not be using then the best devices out there. And so we would rather them be safe, efficient, and effective. So as AgrAbility partners to your other stakeholders, specifically your AT programs and your alternative financing programs, it's built on mutual relationship and respect for each other. And then again, you have that shared goals and responsibilities of wanting to help your farmer continue to farm. And so the last message, because I'm looking at our time, the last message that I would like to say is that relationships are hard and they're murky and they're difficult. But when you do that for your farmers and on behalf of your farmers, this is what we have found in Missouri, because our partnerships have been our key. And again, as Abby said, I don't have to know all the information, and I don't know all the information, and I can't do it alone. And so I am very quick to pick up the phone and call folks. But the thing that I wanted to share the most is because of our built and established relationships, we have found that that opportunity has provided more knowledge and access and availability of services to our farmers and ranchers. We provide resources in a more timely manner. We also then can do rapid fire during those critical times, as Abby alluded to when she talked, that I'm going to use as an example the alternative funding program when a farmer needs something right now, because like Pennsylvania, I can pick up the phone and have a conversation with them and then help our farmer get something that they need in a relatively quick time. And without that relationship, that may or may not have happened. I also like the fact that we have a more integrated approach to our services and our programs to meet the individualized and customized needs of our farmers. And again, that's based off of our relationships. Another thing, which Susan indicated, less duplication of services. We're more efficient, we're more effective in the ways in which we are providing resources across the state. This also leads to a reduction in financial and staff burden on individual agencies and providers, and that's critical. The last two things that I want to stress, because I am a safety and health specialist here at the University of Missouri, as well as the director for our Missouri AgrAbility project, by having this partnership and the coordinated efforts of that two-way communication streak of working with each other, not just with our AT program or our AF program, but also with VOC Rehab, Rehab Services for the Blind, USDA FSA, our Centers for Independent Living. Again, I do have influence. We have influence to decrease safety and risk factors in the home and on the farm, and then leisure activities by the types of adapted and assisted devices and the smart technologies that we might be recommending. And then the last thing, which is key to everything that everyone has been talking about, which is the ultimate goal here when we're talking about alternative funding, we have a better coordinated effort between all the servers that are out there, because these issues are going to be co-occurring. Our farmers and ranchers are going to need financial assistance, and they are going to continue to rely on folks that are on the teleconference today to help guide and direct them into getting the best sources of finances to pay for those adapted and assisted technology, keep them actively engaged in agriculture. And that's all I have. Thank you.
Thank you, Karen. Thank you, Abby. I think that sums it up really quite well of the importance of knowing your partners and having and developing strong relationships. Paul, can we, in the few minutes we have left, are there any questions, or do people have questions that, the four of us might be able to answer?
We do have a couple questions right now, and I would invite anyone that has questions to either go ahead and enter those into the chat area, or you can use the raise hand icon. While you're doing that, we do have our 4 quick poll questions. We'd like to get your feedback, please, if we could. So I'll open the first one. Susan or Tracy would like to address that. We'd appreciate it.
Sure. How long does it usually take to get funding through an alternative financing program? It depends on the program, but I would say if it's a direct loan, meaning the program itself is the funder, they're the bank, it would take a week to 2 weeks once you get a completed application. And for programs like ours where everything over $2,000 we're using a partner bank, again, it would take from getting a completed application anywhere from a week to 3 weeks. If someone needs the guarantee, that means, and many of our programs have the guarantee component, that means the board of directors must, the majority of the board must approve it. But you're still talking from a week to 3 weeks for almost all of the loan programs. What is the typical interest rate for an alternative financing program? I would think the more typical rate is anywhere from 4% to 7%. And it's based on the useful life of the device. So, for example, a tractor would be similar to a home modification loan. So it would probably be out at 10 years. New vehicles typically 7 years. Used vehicles 6 years. A home modification, again, 10 years. But smaller equipment, hearing aids, 3 or 4 years, things of that sort. But all of the alternative financing programs, they're going to work with the borrower to see what is affordable. Some loan programs, and I believe like Northwest Access, which is Washington and Oregon, I think their maximum at this point is 5 years. But you can go on the websites, and we included all of the programs' websites in those links.
Susan?
Yes.
I wanted to mention that in Missouri, our interest rate is 2 to 4%, and we also have a minimum of 500, a maximum of 15,000, and then they also have another maximum of 50,000 if you're going to do an accessibility to a vehicle, which for our farmers would include modifying that truck or that van that they might need.
Correct. I think that's very useful, and people should go to these websites because, you know, our program goes from $100 up to $60,000. And I think you will find the older programs, Missouri, Kansas, Oklahoma, Pennsylvania, the amount you can borrow will be greater than some of the newer programs where they just haven't been able to amass as much capital.
Okay, I will check our chat one more time here and see if there's additional questions. I do not see those right now. We will leave the room open if you want to copy down any contact information or you'd like to access any of the links that are currently in the chatware area. I do want to thank Susan, Tracy, Abby, and Karen again for presenting today. Thank you to everyone who participated. Again, please consider joining us for our next webinar or series, in this case, for the Virtual National Training Workshop in January. So with that, I will say thank you again and bid you all a good day.